This is plenary session number 7. The meaning of life, part 8, the purpose of investment. We're very lucky to have Saka Nusseibeh from Chief Executive Officer of Hermes Investment Management in the UK as our speaker today. I think it's going to be quite an interesting topic. He's obviously well versed in investment, but he also happens to hold a PhD in medieval history from King's College. So he does have an ability to draw some conclusions over a period of time. But I think hopefully we'll be able to get some insight and maybe bring us back into centre about why we invest and how we invest and who we're investing for and the roles that we perform as trustees and superannuation funds. So rather than extend my intro, I think, and take any of Saka's presentation away, I might hand over to him, and hopefully we'll have an engaging presentation. I look forward to your questions.
Thank you very much. So I'm going to spend half an hour or less, 25 minutes, maybe even less, because you'll get bored and you all want to go back home anyway. And I want to really talk about not just how we invest, because that's what most of these conferences talk about, but why we invest. And then I want to suggest to you that the how we invest is based on a lot of fallacies that we take as truths, and we ask the wrong questions. And then I want to bring it back and say, if you connect the why we invest with the how we invest, we might come up with a slightly different answer. And I'm going to be provocative, and I actually do believe that fees are too high and so on, but I'm going to say the following. It's the wrong question. It's actually completely the wrong question. So what were the returns on markets from investments over the last 10 years, right? And when you calculate that, and this is going to come back right to think about this. Beneficiaries, members, and ordinary investors live in society. In my society in the United Kingdom, whatever return on investment was made has to subtract from it the trillion-odd pounds that had to be paid for the bailout of the banks. Because they screwed up, because the investors screwed up. The passive investors did not engage with the companies. So it wasn't cheap at 2 basis points, it was very expensive. Because my tax bill and my daughter's tax bill and her sister's tax bill has gone up in a massive way. It's one whole system. But we'll come back to that. But before that, let me break some more kind of norms. And I borrowed this from the previous presentation, right? There is an assumption in our industry that you've got to be scientific, and somehow scientific and academic is good, right? And if I look at this, and I'm going to make an assumption about the audience here, you're going to assume that academics operate in the top end of that pyramid, right? That's the assumption. So many years ago, when I was still trying to be an academic, I was present in a wonderful debate, it happened to be medieval history at the time, between 2 of the greatest medievalists that Europe had ever known. One was a guy who I worked with, called Alan Brown. He looked like kind of a Tolkien with, a Gandalf with short hair, sucked on a pipe. And the other guy was called Alan Dubé. And Dubé, he was French, presented this paper about his book. And the presentation was wonderful, and it lasted about an hour and a half. And it was the product of 25 years of work. And Alan Brown stood up and looked at him and said, you know I've got to do 25 years of work to refute you, but in my bones, what you just said is just rubbish. And sat down, top of the pyramid. And you think that's just historians. It's not true. Albert Einstein, when he sat through the lecture that described to him quantum mechanics, did not answer it by refuting the argument. What Albert Einstein did was he stood up and said, God does not play dice with the universe. And in fact, that's why Stephen Hawking, almost a century later, said, not only does God play dice with the universe, he sometimes hides the dice. Anyway, that's the background. So, this just shows my age. I don't know how many of you remember Monty Python or remember the movie, but that's what it's based on. The Meaning of Life. It's a great film, and I'm going to refer to it twice. And it only had 7 parts, and I think they missed an important part, which is this part. The Meaning of Life, Part 8. Investment. What is investment about? Well, it's sort of obvious, isn't it? It's about our industry is an industry about providing for people to retire. But actually, that's not an answer. There are 2 points about them, and I'm going to come back to it. The first one is if you look at the picture, they're meant to represent two people who are having a good time. It's not just retiring, it's having a good time. It's enjoying their retirement. And it's not just about money, although money is important. All the discussion is about returns, net returns, and outcomes. But in fact, people who retire want to retire in a contented fashion. That's one. It's what kind of society they retire in, what kind of environment they retire in, and what kind of society they live in. And by the way, mostly, if they're dancing like this and they're cheek to cheek, they probably had kids, and they care about the society they give to their kids. They probably care about the society they give to their grandkids. And we'll come back to that. The other point I want to make about this particular picture, it's a new phenomenon. Investment is very, very old. And a lot of our ideas on investment are not new at all. They're pretty old. We think we're smart, but it's been around literally for thousands of years. But an investment for the vast majority of the people is reasonably new. It's a product of the 20th century. Prior to the mid-20th century, most people were not rich enough to think about retirement. They had to work until they dropped, and then they probably died of starvation unless their kids looked after them. This is a product of modern society. And we've built an industry around it. And because we've built an industry around it, we've built an industry that thinks of itself as an industry. And we've forgotten who our bosses are. Every single person in this room, irrespective of who they work for, whether it's a fund or a union, whether it's a fund management, whether it's a consultant, every single person in this room essentially works for the ordinary investor. And we know something about ordinary investors, and that's why my argument about fees is not an anti-cutting fees, it's actually a discussion about what the purpose is. I know a lot about the ordinary investor because my company is owned by them, 320,000 of them. I'll tell you what they look like. My 320,000 shareholders, and we're a fund management company that's owned by a pension scheme, so we're a hybrid. They're going to retire on between 10 and 15,000 pounds a year. Now that is just below the minimum wage in the United Kingdom. They're not rich, so I know this about them. They're going to care about their health. Their inflation that they're going to use that matters for them is not the inflation in GDP, and we'll come back about GDP. It's very different. The GDP inflation has a smaller component on food, on health, and on housing than the inflation GDP that the retiree works on. So out of the bat, when we talk about inflation targets, we're using the wrong inflation target. That's not the one that the investor cares about. That's the one that we care about. Secondly, they have been incredibly nice to us. They recognize that this is an industry with specialist skills and people have to go to university and be really smart and have lots of higher net returns, yada, 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 yada. And they're willing to let us earn in a month, what they will earn in a year. But they're asking us for something else in return, to look after their interests. And what we've done is we've been incredibly paternalistic in looking after their interests. We've said to them, you know, we know best how to look after your interests. And we haven't asked them what they want, and what kind of life they want, and what the purpose is for them. And these are the questions that I want to come back to when we go through why I think the methodology we've used is flawed. So park that for a bit and we'll come back to it in a minute. Investment is very, very old. The first and the most successful investor of all time was a person who had a garish sense of colors, who clearly was deeply disliked by his own family, refused to be a toy boy, was not popular in jail when he was in jail, but you know what? The ruler of the time liked him. And the reason that Joseph, and that's the guy we're talking about, as in the Technicolor quote, the reason that Joseph was so dur is because his investment methodology assumed that you don't grow the investments. That's why. You just take the money, you put it aside, you half it, and then what you have on the other side is what you're going to get. And the reason that that's not acceptable is that people don't earn enough for this to work. Just think about it. It just doesn't work. And that's why we had the birth of that. And by the way, another way of investment also comes from the Bible, and it shows how old it is, the return of the prodigal son, which is you take the money, you invest it in ventures, there is risk, and maybe what you get at the end is higher than what you started off with. And remember I said that the modern investment is a modern phenomenon. That's why. Because risk-taking could only be afforded by a few. It's been around for a long time. And the princes of Europe, and I mean the merchant princes of Europe and the merchant princes of Asia, knew how to invest. And they understood that investment was based upon trying to do things, and that there were risks. But when they talked about risks, they did not mean risks as sharp meant volatility of the markets. They understood that risk meant losing money. And that's why ordinary people could not afford to invest, because they could not afford to lose money. Most people in this room, unless they are super rich, cannot afford to lose capital. Not really. And that's why drawdown is so important. And that's why investment for a long time was actually the preserve of the very rich, because only the very rich could afford to actually lose capital. And they were reasonably sophisticated. They understood the concept that there were lots of risks. It wasn't 2008 that let us understand there's the unknown unknowns. That's a little rubbish. People understood about the unknown unknowns from the 1st century AD. They understood there was political risk. They understood there was environmental risk. If your ship sank because there was a typhoon, what the hell do you think that was? That was environmental risk happening to you, right? They understood that there were floods and droughts. And they understood that money just did not grow unless you took risk commensurate with that amount. And for a long time, that was understood, and they understood first and foremost, and this goes right back to the conversation we had before we started, before this happened, that the purpose of investment is to grow the underlying assets. Real return. I mean, people talk about real return now as if it's a new concept. What do you think people were investing for years? Interestingly enough, and this is no attack on consultants, the Barings Bank had a widows and orphans pension fund. And it had a bunch of people investing, and it did not obey any of the rules that any of us in this room take to be good. They had no concept of efficient frontiers. They had no concept of diversifying risk. There were times when they put all of their money in a single stock in India, and there were times when they put it in cash, and there were times when they diversified it in stocks in the United Kingdom, in Europe, in Australia, and so on. And you know what? For 200 years, its returns were stellar. So stellar, it could have saved the actual bank from going bankrupt. And then in the 1960s, they went modern. And they employed multi-managers, efficient frontiers, yada, 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 and look at the performance now. It's rubbish. And do you know why? Because they forgot the purpose. The original fund had a very simple purpose. It was to make money for the widows and orphans of the executives of the bank. That's it. They made real money. There were years in which they made no money at all. It didn't bother them. They just hid the money. And there were years when they made lots of money. And that didn't bother them. They just hid it. They did not know the theory. And because they did not know the theory, they did incredibly well. That sounds crazy, doesn't it? They did not know the theory, and that's why they did well. And the reason is the theory is flawed. Now, I'm a historian, so let me take you through a story about history. See, we all believe in certain truths in this room. And these certain truths that we all share, because we all went to the same kind of university, learned the same kind of economics from the same kind of books, and because we all look at the same kind of Bloombergs, these theories are based on flaws. And we all share them, and because we all share them, we all think this is the norm. And here are the flaws that this theory shares, all of us. Sometime in the late 18th century, people, particularly in the West, got convinced of the idea that growth, GDP growth, whatever the hell GDP might be, is exponential and forever. Why? Because there is a combination of a growth from population and from new territories and from new technologies. That's why the Mississippi bubble happened, right? It was this idea of exponential growth. The idea that there were new territories to conquer by Europe, and these new territories are going to give you huge amounts of growth. Okay, there were people living in these territories, it's a bit of an inconvenience, they shouldn't have been there, but what the heck, it'll grow. And then when eventually the Europeans thought, well, it's okay to have these people, they said, well, that's a good thing, you know, because when the people live in these territories, what we can do is we can make them more like us, right? We can make them more middle class, they can buy machines just like us, and they can be like us, and they can wear our kinds of clothes. And that's how the South Sea bubble happened, right? We're going to sell them the stuff that we have. And by the way, this is not talking about back then. Why are we investing in China? Isn't it because we think the people in China are going to be just like us and they're going to go and become middle class, and there's this thing about the Chinese becoming more middle class? It's the same thing. So, exponential growth. Second, unlimited resources. There was this idea that resources in planet Earth are unlimited and they're there for the taking. Yeah? And that's exactly where we are now. We get really upset when we hear that the economic number is zero growth. That's bad. Why is it bad? Sorry. I mean, genuinely, why is it bad? Who said it's bad? It's only bad if you think it should grow every single year forever. And if it grows every single year forever, what does that mean? You're going to use all the resources, right? We're going to come back to that too. So that's the first element. The second thing that went wrong is that sometime in the 19th century, the economists discovered science. And that was a big disaster. I promise you, that was the biggest disaster in history. The economists discovered science. It's an absolutely true story. It happened in France. They basically opened up a science book sometime in the 1880s, and they looked at it and said, my God, if only investment and economics can be exactly the same, we can have immutable laws of economics. And the whole argument between Keynes and Hayek, by the way, still assumes there are immutable laws. There are no immutable laws for economics. And by the way, the economics that they looked at, this 19th century economics, is based on 19th century science. If you think about what we talk about equilibrium, right? Right? Don't we? Equilibrium in demand and supply and so on? Right. I got news for you. Science dumped equilibrium about 120 years ago, right? Science thinks now that equilibrium means death. In fact, a group of scientists sat with a group of economists in Santa Fe in the mid-1990s. And the scientists listened to the economics. These are top economists, right? And the scientists went, wow, this is really exciting. You guys have taken something that was said 150 years ago, you've completely ignored all the developments, and then you've developed a theory based on it. This is really interesting, right? Because science has worked out that nothing is so simple to demand just 2 or 3 or 4 or 5 factors. And that's where complex adaptive theory comes in. And the reason why modern economics now is looking at complex adaptive theories, by the way, and a complex open system for the universe. But the point I'm trying to make is, there was born this idea that to make this pile of money, what you need is some rules. Now, I flew here, and it's fantastic to come to, I love coming to Australia because it's wonderful. But I flew here on a 380 because the laws of physics are immutable. I mean, I'm sitting in a thing which is made out of metal, right? It's stuck there because essentially there's a vacuum created over the wing. It's a scary thought, right? But I'm reasonably comfortable because I sort of roughly know that physics works. And I know it works because you can repeat experiments and observe it and see that it works. We don't know how economics work. The reason that there's this argument between Keynes and Hayek is because no one can actually do it in a lab, right? There are no rules. But park that. Second thing that happens is in the 1950s and 1960s, in the midst of the great excitement of the growth of the 60s, something else happens. In Chicago, guys take economics and take it the next step forward. Between Markowitz and Sharpe, they create financial investment as a science. First, let's start with Markowitz. Okay. Do you know why beta was created? Hands up. Does anyone know why beta was created? Michael does. Why was beta created? It's simple. Markowitz was trying to work out the correlation between returns on stocks and the upside, so the price and the upside forecast by the brokers recommending the stocks on Wall Street. And he used to work at the time in RAND. RAND at the time basically specialized in observing the submarines of the Soviet Union. And there was a computer in RAND. And he took it down to the computer operative and he said to him, can you do this correlation of these 75 or 750 stocks to each other? And the computer analyst said to him, sorry, it can't be done. There's no computer in the world that's big enough. But what if I correlate them all to a single factor? And let's call that factor beta. Right? But we all talk about alpha and beta as if it really exists. It doesn't exist. We just made it up. And Sharpe understood that risk could not be modeled. So he said, let us substitute volatility for risk. Really? Sorry, no. Let us substitute volatility for volatility. So when we talk about information ratio, we're not talking about risk-adjusted return. We're talking about volatility-adjusted return. It's not the same thing. It's not the same thing. And we forgot that risk means political risk. We heard in the previous but one panel about the risk of the Soviet Union. Guys, wars and losing your money used to be a factor in investment, and let's all wake up. It's going to come back. I mean, just look at the Chinese. I mean, we're all surprised that the Chinese are a military power. Really? That's just normal risk. So let's wrap up on the flaws that we think there are in the theory. The idea that somehow economics can be modeled, not true. That somehow, because it can't, it's not a science. That the world can grow exponentially and forever and the resources do not matter, not true. And somehow that we can model everything so that we can make a system that all of us can learn, where scientifically we can have better returns with very little volatility. We all implicitly believe that. There used to be people who also implicitly believed that in Elizabethan England. They were called alchemists, and John Dee was the best amongst them. It cannot happen, right? It just mathematically is not true. And because we all believe that, we have focused more and more as an industry on the mechanics of the how. So we talk about returns, we talk about risk-adjusted returns, we mean volatility-adjusted returns. We talk about factors of investment, we talk about different kinds of investment. We talk about tactical asset allocation and strategic asset allocation, and so on and so on and so on. And we increasingly build an industry which is very expensive, and we forget it's intuitive. Do you remember I started with that pyramid? What was the point of that pyramid? It wasn't to put down the idea that you should have logical arguments. It's to say to you that even in the highest of human achievement, in art, in science, people often go with instinct. It is not about modeling. There is no surety. A lot of it is about gut instinct and thinking things through common sense. What's wrong with common sense? And because we've done that, we've gone down the route of specialization. So we talk about benchmarks and benchmark returns. And we forgot it's not about benchmark returns. Actually, it's about just making money. And so now, 28 years into the industry, I'm told that the new thing, the innovation, is something called a solution. Sorry, that just used to be called balanced when I was a kid. And it is about absolute return and real return. I thought all investment was about making money. I mean, I never thought that investment was about losing money, right? It's just nonsense. And the reason it's nonsense is we've forgotten the purpose of it, and the purpose of it goes back to these people I showed you. Now, why didn't we discover it was nonsense? Because actually the world was going through a good time, maybe, but fundamentally because the population was growing. And so what was happening was, actually we were doing things exactly like we did in the Middle Ages. The young were paying for the old. It looked as if the system was working because the young were paying for the old, and science did something to us, and it did this. We live longer. We live longer. In 1945, when the NHS system was introduced in England, the greatest and the best thing that ever happened in a capitalist society, whereby people, ordinary working class people, were told, you don't have to worry about your retirement, you don't have to worry about health, it's all going to be paid by the community, by the state. The calculation was that an average person who worked in a factory died within 5 years of retiring. The average bank clerk died within 10 years of retiring, and the average damned lord died within 12 years of retiring, right? The problem that the industry has is, we're living. That's the problem. So you go back to the Joseph story, it's not 7 years, we're talking about 40 years. And in the previous panel, the point made that actually the sensible thing to do is to put all your money in growth assets forever is absolutely right. If you're going to live for a long time, that's exactly what you should do, because it's not going to be enough. And that's why the system started to get broken down. Now, finally, all that came together with the asset management industry, the investment industry collectively behaving like, well, a mad scientist. Look at the hair, see? Same thing. What do I mean by that? We developed this bizarre idea that we are outside the system. Fund managers will say to you, we observe markets, we see discrepancies, and then we act on them. Super funds will say to you, we do an SAA that observes markets and makes great returns on it. By the way, this isn't my point, this was made by somebody else, by an Australian called Ross Barry, in a great book he did about the history of complexity. I really recommend it. We think, to use economic terminology, that we as an industry are exogenous to the market. Guys, I've got news for you. We are the market, right? We collectively, we are the market. We cannot observe the market and use it because we are it. The size of the world's saving is about $84 trillion, according to some very famous fund management house. The size of the world GDP apparently is $78 trillion. I'm still trying to work that out in my own mind, so there are more savings than the world is worth. But let's leave that aside. But the fact is, the reason that we think momentum works is because we all think momentum works. The reason we think Warren Buffett works is not because there is an immutable law of physics that says value stocks go up, it's because we all believe that. If some mad scientist were to put something in the water and every single investor in the world would think tomorrow morning that companies with CEOs who have red hair go up more in price, that's exactly what's going to happen. We make the rules. Just think about momentum investing. When did momentum investing become fashionable? It's when people discovered that the Japanese rice traders used to use it and emulated it. I mean, now we call it behavioral finance, right? What is behavioral finance? We look at the people around us and we imitate them because we are the market. We are the market. So we have to understand that our actions, and this is where it comes down to the crux of this, our actions actually affect the market and affect the society that we create. And I come back to the first point. We are not working for ourselves. We are not working for the companies we work for. We are working for the people whose money was given to us in trust by them to try to give them a happy retirement. Not to give them a return, not to give them an income, to give them a happy environment. And actually, in the pursuit of simply nominal returns and net nominal returns, we've lost sight of the fact. In pursuing net nominal returns, we have followed through on false premises and a false theory. And that, in conjunction with the fact that we forgot who we're investing for, allowed us to come out with the wrong outcomes. Because the decisions that we make with our beneficiaries' money actually creates the world they're going to live in. If we put all of our beneficiaries' money in passive funds, for example, that do not engage with companies and that look for just nominal returns, then we are creating a world that has slave labor. That's a reality. Sorry, we're just creating a world that has slave labor. And you have to go back and ask the beneficiaries for 0.1% less, 1% less. How would you feel about bequeathing to your children and grandchildren a world with no slave labor? This is not about morality, as somebody on an earlier panel said. Actually, this is about self-preservation, because I tell you what, if you create a world with slavery, you're going to have political disruption. If you're going to have political disruption, you're going to have revolutions. If you're going to have revolutions, you're going to have nutty terrorists who start blowing up things and coming to Europe and dying in boats. So it's about self-interest. It's not about morality, it's about self-interest. And in the narrow confines of simply the highest possible nominal return, and that's it, you're not asking the right question. If we just go for absolute nominal returns and no more than that, what kind of environment are we giving to our next generation? And if we create a next generation that has a belief that you can subjugate people and you believe you can use little girls and traffic them to become slaves for whatever reason, if you poison the waters and the rivers that we live in, actually you're not bequeathing the right environment to the beneficiaries whose money you're investing. And as I said, it's a bad investment. It's true, it doesn't come up in volatility, right? But it comes up in risk. Because if you create that environment, you create a politically unstable system worldwide. And if you create a politically unstable system worldwide, it will come and hit you. And you have to think about these risks. And you have to think about the positive impact of not going after the highest possible nominal return. Shall I repeat that again? You should not go after the highest possible nominal return. Am I nuts? Isn't this against your fiduciary duty? No, it's not. It's bang in line with the fiduciary duty. So who said to the investment banks in 2004, 5, 6, and 7, excuse me, 20% ROE is too high, you're doing something wrong, stop. Where was our fiduciary duty then? And the impact of that is massive. It's massive. It's not just the depression that lasted after the great financial crisis. It's the fact that the two people who I showed you, your members are straddled with, well, not in Australia, but everywhere else in the world, are straddled with a massive public debt, right? Now, you've got to deduct that from the money you gave them. So it's not that you made them 15%, you made them negative. In fact, if you put that into the equation, the return on investment was negative to a huge amount. So you should have asked the right questions. You should have asked about governance. You should have asked about the environment. You should have asked about too much return, about too much risk. If you don't ask these questions, if you don't think about the world that these people want to inherit and live in, you're actually not doing your job. No investor that you represent wants to live in Gotham City. It's not true. That's not how the average member who hires you thinks they want to retire. And if you think that by giving them 2% more per annum, and that's a lot, 2% more per annum, right, is going to make them happy if they're going to live in that, you're wrong. That's not where they want to live. This is where they want to live. Green and pleasant land. And to arrive at green and pleasant land, you have to ask yourself the question, how do I achieve what they want? And then you have to step back and say, Let me just forget about the rules. Let me forget about the fact that there is immutable laws of economics and that investment is a science. Let me understand that investment is an art, which is why, by the way, so very few people can do it well and why they demand higher fees, the few who can do it. And let me understand that actually part of my investment process has to be about the outcome for the whole of society, for stakeholders, that the people retiring. Let me consider the fact that the idea of exponential growth that the Mississippi bubble started is actually a load of nonsense. That it's natural at some stage that growth actually does not go up as much. Let me consider the idea that the resources on planet Earth are finite and they will run out. And that all of these, although it doesn't come up in my 3-year numbers or my 5-year rankings, do matter because they're the difference between a Gotham City and a green and pleasant land for retirement. And let me consider this finally, that in caring for others, by standing against things like slavery in emerging markets, by engaging with companies on good governance, by engaging with companies on diversity, I'm actually creating stability in the market environment. Because the lesson of 2008 was not that there was a mistake in the credit market. The markets did not fail because there were bad investments in bad loans and mortgages. That's not why the markets failed. The markets failed because there was a failure of governance. And it was a failure of governance by all of us collectively in the industry. Because none of us stood up and said, such high returns are unsustainable. It's about sustainability of returns. None of us questioned the gospel of the economics that was handed to us by the 19th century economics tutors. And none of us questioned the idea that somehow there's this myth that you can create a model that tells you everything about investment. Thank you very much.